I want to welcome you back to my channel. And in this video, we're going to talk about supply and demand. And so we've had quite a few subscribers to request this particular video. So I'm going to break it down so you guys can understand it, recognize it, how to trade it, understand how the market moves with supply and demand, and how it can really help your trading when looking at the market or looking at structure from a supply and demand standpoint. Okay, so as you guys can see, I have these examples here on the screen. And so the most basic question, what is supply and demand? So I'm gonna break it down like this. Let's say Apple, for example, they release a line of new iPads, and according to Apple, this is supposed to be the King Kong Bundy of iPads, the iPad of all iPads, and they're anticipating on selling a lot of these iPads. However, they discovered that they can't necessarily sell these iPads because the price is too high. So no one really wants to buy these iPads. So ultimately, what that will do is Apple will start to drop the price of their iPads until they get to a point where consumers, the people, want to actually pay that price. So what this is called equilibrium in the market. And as you can see, when we get to this point, price starts to consolidate, because at this point, buyers are willing to buy the iPads. But let's just say that there were, let's look at another example. Around COVID, paper towel and alcohol and all type of cleaning products were scarce. So the demand for these products was extremely high. So at this point, the consumer, us, we were demanding these products, and so price started to increase for those particular products because the products were scarce. The demand exceeded the supply. So when that happens, that's when the price gets driven up and the demand is extremely high. Now, when you have these rapid movements like this in the market, these create what are called imbalances. And imbalances it pretty much is when the price has such a significant move that it causes these massive spikes within the market that have imbalances in them. And so in order for these imbalances to come to equilibrium, prices have to come back to a level and where demand and supply are pretty much conversely meeting in the middle, which causes what is called equilibrium. Okay, so now let's look at this on the charts. USD CAD. And so one of the things I want you to understand about supply and demand zones is, for supply zones, they usually happen at the top of a leg of structure. And how I mark it up, there's many different ways that you can mark up. However, I usually find the last up candle before the down move. And so when you're looking at demand zones, it usually happens at the bottom of a leg of structure, and it's the last down candle before the up move. Okay, so let's break that down and I'll show you guys exactly what I mean. So if we're looking at these legs of structure here, as you can see, these peaks and valleys, you can see things like this. Each big move like this is considered as a leg. This here is a leg. These are legs of structure, okay? And so supply and demand zones usually happen at the peaks and valleys of the legs. So if we're looking at supply zones, it usually is at the top of a leg of structure and the last up candle before the down move. So if we look at this candle here, this is the last up candle before the down move. We will mark up this entire area here. And so, as you can see, price dips off away from this area, come back to retest within this supply zone. Okay, let's go ahead and make the supply zone gray. Okay. All right. Now, one of the things I want you to understand, supply zones and demand zones are formed from order blocks. And order blocks, if you guys want to understand what order blocks is, if you look right here, there'll be a video that comes up that you can find out about order blocks. But from here, you can see with the supply zone, price dipped off away from here, tapped into this level of supply before it decided to dip off again. Now check this out. At the bottom of this leg of structure here, the last down candle before the up move. And what do we say about demand zones? We said usually happens at the bottom of a leg of structure, last down candle before the up move. Okay, so if we blow this up, we can see this is at the at the bottom of a leg of structure. Mark up this entire candle here. And what happened? We can see price dipped away, came back into this level of demand. We'll make this blue. Dipped into this level of demand, decided to rapidly come away. Now check this out. Price came down here, gave a pullback here. Now, because the market is fractal, and what I mean by that is you have different trends on different time frames. Right now, we're on a 4-hour time frame. However, this here is a supply zone. So if we're looking at this, the last up candle before the down move, this here, you can see price decided to dip into the supply. Let's make this gray. Dipped into the supply here before it dipped off. Okay, come down here at the bottom of this area here. This is the last down candle before the up move. Okay, price dipped into it before it shot off. Now check this out. Here's the last up candle before the down move, or you can actually consider this one as well. But in this example, we'll just notate this entire candle here because this is literally the last up candle before the down move. You can see price dipped into this area before it dipped off. Now, when you have rapid movements like this, it creates what are called imbalances. And so what is an imbalance in essence? So as you can see, we have a candle here, and we also have this candle right down here. Okay, so in essence, the candle on the left and the candle on the right, if the two don't meet, then it causes an imbalance. And what I mean by they don't meet, if you notice, there's a gap in the market here. Right here, there's a gap, meaning that no candlesticks or wicks and prices have closed this out. So for example, if we notice, look at these two candles here. You see a wick that came up here and a wick that came down here. There's no gap in the market. So here there's a massive gap. Okay, so in order to bring equilibrium back to the market, price decided to come up and close out this gap in this area here. You see? Now the gap is closed. Okay, so that's how the market brings equilibrium back to the market. Okay, price closed out the imbalance, tapped into this level of supply, and then it dipped off again. Okay, so now let's talk about how you can actually catch sniper moves and things like that, looking at supply zones within supply zones, demand zones within demand zones on smaller time frames. Okay, all right, so we're on a 15-minute time frame, and I'm going to break it down and show you guys how we can break down the market and catch sniper entries by using demand zones inside of demand zones, or vice versa by using supply zones. Okay, so if we notice here on a 15-minute time frame, we are in down structure. Lower low, lower high, lower low, lower high, lower low. And we're getting a break of structure in this area here. Okay. And so one of the things that we can see is we have a demand level right here. Last down candle before the up move. 15-minute demand. So one of the things we can do, we can place our long tool here, about 10 pips or so, and we can look to ride price up to this area here, or possibly to this area right here. Okay. However, we can probably catch a better sniper entry from a lower time frame. So let's drop down to the 5 minute, and you can see that we have another demand level here. Okay, which we possibly can move our long tool down and have a better risk to reward. So let's go ahead and play price. See if it'll actually get down there. And this is where the patient game comes from, you guys. Bam, there it is. Look at that. Tap right into our level of demand, and then let's see if price will actually take us to our TP, or if it'll stop us out. Well, there it is. So as you can see, price dipped into our level, our smaller level of demand, before it decided to dip off. Now let's drop it to a smaller time frame just to look and see what's happening on that level as well. One of the things that you can see is on this 1 minute time frame. We also had, let's move this up a little bit, make it a little bigger. On the 1 minute time frame, we had a demand level here. And what did price do? Price, let's move this out the way so you guys can see it. Price actually dipped into the 1 minute demand level as well before it dipped off. And so as you can see, when you break it down on smaller time frames, you can see demand levels within demand levels, but you can hone in on your sniper entries. That way you can minimize your risk but maximize your profit. Hey, you guys, let's go ahead and recap. All right, you guys, one of the things I want you to take away from this video is understanding that demand happens on the bottom of a leg of structure, supply happens on the top. But both supply and demand can also happen within the middle of a leg of structure, depending on how the market is moving. However, understanding that when demand exceeds supply, that drives the price up. When supply exceeds demand, that drives the price down. Okay, bringing equilibrium to the market. Okay. Hey, you guys, I hope this was informative. I want to thank you for watching.